Well, hey there, everyone. Happy Monday. Happy Monday, July 6th, 2026. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully sunny Redmond, Washington. The weather here in Seattle is pretty ideal. It's actually a little warmer than normal. We got a high around 80, which is pretty steaming hot for these parts in the summer, but all excitement ready for the U.S. big showdown with Belgium at 5 p.m. Pacific tonight. Oh man, after this, we're going to be getting ready for the match. In the meantime, we got a lot of fun charts to look at together. Nice risk on day to kick off the week. Risk assets generally moving higher. We're going to see technology back to a somewhat unfamiliar spot at the top of the leaderboard. We'll talk about how some of those leading names like SanDisk and others, the question is, do they continue in a position of strength, or do we start to see further weakness as we observed last week in some of the names like Micron and others? Lots to talk about today. We're live streaming, as always, on Facebook, LinkedIn, YouTube, and X. I appreciate you guys so much tuning in live. Those of you that are doing so, I'm seeing comments and questions already on our YouTube channel and in other places. Anywhere where you're seeing the live stream, if you're tuning in live, you can ask questions all along the way. I'll do my best to keep an eye on the chat and answer questions as we go. If you're watching the show later on our YouTube channel, welcome and thanks for checking it out. Please drop a question in the comments section on our YouTube channel. If you missed Friday's episode, by the way, it was an all mailbag episode. Pretty fun, actually. Some really thoughtful questions, as always, from a number of you guys over the last week. So check that one out. We're planning another mailbag episode this Friday. All right, to kick things off here, the S&P 500, kind of a nice open, kind of a nice bulk of the day, kind of a nice finish. Traded off in the last 30 minutes of trading, but overall, this is a pretty resounding update. That's enough to put the S&P up above 75.37 at the close. That's up about 0.75% from Thursday's close. Of course, Friday was a holiday for the 4th of July celebration here in the U.S. The Dow up about 1/3%. Actually spent most of the, or at least half of the day in the red, but then flipped green in the afternoon. After around 2 p.m. Eastern, really looked, continued onward to close just above 53,000 at the close. And the Nasdaq Composite, the best performer, with technology at the top of the leaderboard. That's not surprising. Defensive areas of the market, particularly the Dow utilities, as you'll note, down today. Volatility also down as well. And I would say that's been, one of the key signals that we've been observing here, right? I mean, with the VIX down below 16, VIX down around 15.5 at today's close, that is a low volatility environment. That basically means the options market is pricing in fairly low price swings day in, day out. That's usually really good for risk assets and just suggests a general, risk on mentality. So in this kind of environment, I just think of the market as innocent until proven guilty. And we think about some of the things that would tell us that we are seeing similar conditions to previous market tops. A spike in the VIX would certainly be one of those things that has usually been the part of the beginning of any sort of major bear market rotation. So for now, low volatility, low risk, according to the options market, of a big downside turn. Looking at interest rates, kind of mixed today. You can see the 10-year yield right around 4.48. That's down slightly from Friday's session, or Thursday's session, I should say. The 5-year point around 4.2%. The long bond yield pushing up a little bit, but finishing the day just below 5%. The TLT, which is a bond ETF that we like to track, ended up almost flat for the day after a weaker open. First hour of trading relatively negative, kind of creeping back to the green. The dollar actually opened a lot stronger and lightened up through the course of the day. So currency markets, certainly fixed income markets, sort of had a kind of a significant open, but then kind of settled back in to not change too much directionally from where we finished trading at the end of last week. Commodities as a whole were up, but a lot of these were not up. I mean, I would say that the main area of the commodity space that looked pretty good today were the soft commodities, the agriculture items like wheat, corn, and soybeans, as you can see at the bottom, all having pretty good days today. Gold and silver are actually slightly negative. The chart of gold, I would say, still chart challenged in a clear downtrend pattern of lower highs and lower lows. Silver in a very similar configuration. I did grab a chart of the GLD just to update on the short-term rally we're seeing just in the last week or so, but why I would say the long-term structure still remains fairly bearish at this point. Crude oil, Brent crude, both down slightly. These really have been choppy from the end of last week, really through trading today. Interesting to see some energy stocks actually breaking out. Not all of them, but some of them, like MPC, for example, not too far off of all-time highs, even though crude oil has come down pretty aggressively. So again, on the commodity space, it really wasn't precious metals today. It really wasn't energy as much as it was soft commodities like soybeans, corn, and wheat. We do have Miss Schneider coming back on the Market Misbehavior podcast here in a couple weeks. Have not caught up with Mish in too long. Mish is a fantastic technical analyst and trader educator, but also used to trade ag futures on the floor. So always fun to talk to her about things like soft commodities. So we'll certainly pick her brain on that particular market, among others. Cryptocurrency is kind of a choppy day for Bitcoin. Actually rotated much lower earlier in today's session, but as we're doing the show after 2 p.m. Pacific, 5 p.m. Eastern, we can see Bitcoin back up toward the highs of the day. So currently pushing 64,000. Chart of Bitcoin, the most telling part of that chart, I would say, is the bullish momentum divergence. We'll go through that chart in a few minutes as well. But nice recovery after a downside rotation today. After a pretty nice Sunday. Sunday was actually pushing above 60,000, kind of making some gains up above 63,000 as well. You can see kind of low movements in terms of percentage changes and generally mixed result from cryptos today. By the way, latest episodes of the Market Misbehavior podcast were out over the holiday. We had 2 episodes that we shared with you. One was Mike Willis, who's the founder of Cyber Hornet ETFs. We talked a lot about Bitcoin, other cryptos. He's an early Bitcoin investor, and it was really interesting talking about sort of how he's seen that space evolve. I'd encourage you to check that one out. Certainly a long-term bull thesis on cryptos is how I would describe that discussion. And then Carter Worth, founder of Worth Charting and CNBC's Chartmaster. We had a really good conversation end of last week. Just got that out for you over the weekend as well. It's a really good episode. He's a fantastic technical analyst and a really fun conversation. I hope you'll enjoy both of those. Looking at the 11 S&P sectors, mixed results today, big time. But the one at the top of the list was up significantly more than other sectors, and it happens to be the biggest sector by far in the U.S. We're talking, of course, about technology. The XLK was up 1.7% today. Financials and industrials completing the top 3, both up 0.9%. I did a special, I should say my normal weekly show on Stock Charts TV just earlier today. I don't know if that's posted yet, but I did my top 10 charts to watch for September. Oh, Lord. For July, that is. That's the month we're in today. For July, and only one technology name, but I focused most of the picks in financials and industrials. So it was interesting to see those 2 sectors at the top of the leaderboard today. You can find that on the Stock Charts TV YouTube channel. Got a handful of sectors at the bottom of the list, all down just over 1%. They're all defensive sectors, healthcare, consumer staples, and utilities. So what do we make of a day like today, just to take a big deep breath and a big step back? So, technology had kind of a weird week last week, right? Monday and Tuesday were the last 2 trading days in June. And a lot of technology did quite well, actually surged higher those first 2 days. Wednesday and Thursday, the first 2 trading days in July, and all of the technology generally rotated lower. So was very interesting to see how things reopened today. We'll see in the heat map some mixed results in technology, but as a sector, having a pretty good, strong start to the week. So we're I think of this market as technology and everything else. We're back to technology at the top, but note that financials and industrials, 2 more cyclical sectors, more economically sensitive sectors, both having a pretty decent day as well. Not as good as tech, but still pretty good. And so this is a reminder that there are plenty of good charts to be found in a lot of the different sectors, but particularly in some of those sectors that are doing well on a day like today outside of tech. I think many of us probably overweight tech still, I would guess. And so finding opportunities elsewhere that are doing well can be really valuable. And then the other part of this is the 4 defensive sectors lagged today, and we're all down. So back to offense over defense to start the week. If that would continue, that would give me more confidence in the S&P 500 resolving to the upside out of that coil pattern that we discussed on the show last week. Looking at breadth conditions, decent breadth, but technically neutral across the board here on the New York Stock Exchange. 54% of stocks up versus 43% down. In the S&P 500, almost flipped, 44% up, 56% down. So plenty of stocks were up, but not a ton. This is really more of a neutral breadth day after some pretty good breadth readings that we've observed in recent days. Looking at the 9 Morningstar style boxes, you can see large cap growth is obviously with tech at the top of the list, and a lot of mega cap growth stocks doing pretty well to kick off the week. Large cap growth, the best place to be today. Small cap value, the only one of the 9 that was actually in the red, but you can see this was generally large over small and growth over value to kick off the week. Looking at the what we call Dave's Dirty Dozen, the formerly named air quotes Magnificent Seven and Friends. Had to change the name because these charts are just not generally strong right now, but some nice bounces higher to start the week. Tesla recovering from last week's pullback, up 6.7%. Broadcom finally getting a win here today, up 3.7%, outperforming the S&P, and Meta having a nice bounce higher, about 3% there. On the downside, only 2 of these names finished in the red. SpaceX joining the Nasdaq 100, I think tomorrow, if I remember right. Everyone rushing to get this stock listed in their indexes and in the benchmark. So that'll be joining the Nasdaq 100 shortly. Down 1%. Microsoft down 1% as well. And NVIDIA not getting the Broadcom bounce, up just slightly today. All right, let's check out the heat map. As a reminder, if you're tuning in live, you are welcome to ask questions as we go. Just use the comment section in any of the platforms upon which we're live streaming: Facebook, LinkedIn, YouTube, and X. If you're watching the show later on our YouTube channel, thanks for checking it out. Please use the comment section there to ask questions. We'll hope to answer your question in the mailbag episode on Friday. Looks like Spain just beat Portugal, by the way. So whoever wins this evening, hopefully the U.S., but maybe Belgium, would play Spain in the next match coming up later this week. All right, heat map. Let's see. So pretty good day for technology, as we mentioned on the front page. It's worth noting that some of the biggest names, looking at you, NVIDIA, Microsoft, Micron, Applied Materials, these are some of the top 10 stocks, just not generally moving higher today. But overall, pretty good day for tech. While the VIX is low, right? And so the low VIX basically suggests small percentage swings in the S&P, right? That's what the VIX is really trying to quantify, trying to measure. That's not the VIX for technology. And so I would say big percentage swings like we're seeing for Western Digital, up 7% today after being down double digits some of the days in the last week. And you will see similar kind of severe percentage swings in semiconductors and a bunch of other software names as well. The VIX for tech would be aggressive at this point, fairly high, right? Because there are big percentage swings happening on individual names within the technology sector. Having seen that, what was up today? So I'm noting, obviously, the storage names, Western Digital and Seagate, have really been going risk off in the last week or two. Nice bounce to start the week. I would say those charts are still weaker in the short term, but certainly would love to see that rotate higher. CrowdStrike making a new all-time high today. So certainly not all technology names at or near new all-time highs. As a matter of fact, a number of them are really fairly far away from previous all-time highs. But looking at PANW, looking at CRWD, both making new highs today. Outside of that, it's again charts like Empower. Just not great charts. I mean, they're not horrible charts. They're just not great charts. I mean, at best, it's a good chart. What strikes me about the chart of Empower, and to be honest with you, it's just the last couple of weeks have been clearly a distribution phase, right? So we had a nice bounce in April, a nice accumulation period. Then we have this sideways consolidation phase, but then that changed in June. Now we're seeing on the tactical time frame lower highs and lower lows. But if you take a big step back from the chart, we're still above an upward sloping 200-day moving average, right? So the long-term trend is not that bad yet. As a matter of fact, this pullback looks a lot like pullbacks that we saw in March, pullbacks like we saw in November of last year, in terms of time duration, in terms of price deterioration, drawdown, within the same ballpark. The RSI in these previous times always got down to right around 40, didn't get much lower than that, and then we had a nice recovery. And note with that, getting back above the 50-day moving average is usually a really good sign that whatever pullback kind of thing was happening. When we get back above the 50-day, I've learned not to fight it, because when you have this like initial bounce, it's always easy to fight it and be like, well, it's just going to be a quick dead cat bounce before the next leg lower. But when we get back above the 50-day, I've learned, okay, trust the fact that the chart is now making a new swing high. So for now, RSI right at the lower end of the acceptable range at 40, price pulling back to still a comfortable range above the 200-day moving average. But if that would change, and all of a sudden M-Power looks like a pretty ugly chart. Semiconductors generally are in this type of pattern, right? Generalizing across that space. So for now, it's just defining that lower that risk level, right? That level with which you're comfortable still holding the name, and see if they hold. Outside of technology, what else is going on in the financial sector? We highlighted Visa and MasterCard last week because they accelerated higher. Both of those pulled back today, but both had made new 3-month highs on Thursday's session. So nothing to be concerned about yet. And I still think that's an area of emerging strength in financials, but there are a lot of them, to be honest with you. I'm noting Morgan Stanley, Goldman Sachs, both had made pullbacks, making a bit of a higher low and now rotating higher. JP Morgan in that similar space, making a new all-time high today. Also other names, right? Charts like Schwab, what was another one? WFC, both making new 3-month highs today. State Street and a number in these, and what we call that asset management group, all having really good up days as well. So I continue to find really compelling charts in the financial sector across a number of different groups. My scan that I run regularly for stocks making new 3-month highs, a lot of financials appearing in there right about now. Elsewhere, I would say in the industrial sector, very limited. In the communication services sector, very limited today. Most things struggled in both of those. On the downside, healthcare, and not a great day today after some really impressive runs in pharmaceutical names like Merck and biotech names like AbbVie. Kind of a rough start to the week. I would say both of those charts that I just mentioned, still good charts, still making higher highs and higher lows, but just pulling back and not really thriving in today's environment. Consumer staples, definitely a weaker sector, as were the other defensive sectors, particularly utilities and real estate. But the final point I would make is in the consumer discretionary sector. This is a fairly diverse sector of a bunch of different types of companies, all kind of crammed in there in consumer discretionary, but a number of these kind of a weaker start to kick things off this week. And TJX might be a good example to look at. I mean, this is one of those failed breakout names. I remember, looking at TJX closely right around this period. This is mid-June, making a new all-time high. Looked like it could do no wrong. And then it started failing, right? And this is why we use moving averages as an initial stop. That's why the 21-day EMA is always the first level that I look for. It quickly went through the 50-day after the 21-day, now sort of sitting at the 200-day moving average. And I think when you look at charts like TJX and you zoom out far enough, you can see how rarely it's actually touched the 200-day moving average. This is the big slow moving average in red, right? When you zoom out enough, you can see that these pullbacks are part of a much larger, longer term uptrend phase. And so should give us confidence that TJX is still a pretty good chart. But what happens if we start pushing below the 200-day moving average? All of a sudden, it's looking unlike the last couple of years and starting to feel like something a little more different. So charts like this, I would say for me, right at that point of no return, where much more deterioration from this. And I don't think you can firmly say that's a great chart anymore, right? I always talk about innocent until proven guilty. Below the 200-day is guilty until proven innocent. We have to flip that thinking, I would argue. All right, I've got a lot more charts to discuss with you here in a moment. Before I do so, I want to give a shout out to one of our partners, Seeking Alpha. Thanks so much, guys, for being long-term supporters of Market Misbehavior. They are currently in the midst of their summer sale, and I actually just found out they've got an event coming up in a couple weeks, July 14th, top stocks for the second half of 2026. That's featuring Steve Kress, who runs the quant team at Seeking Alpha. He's going to be on my podcast later this month. If you sign up today at marketmisbehavior.com/Seeking Alpha, as a new member, you get 25% off. It is a site-wide deal. I would encourage you to check it out using the QR code or using that website. And thanks again, my friends at Seeking Alpha, for supporting the channel. You can go to marketmisbehavior.com/Seeking Alpha. You get access to their premium membership, including that top stocks for the second half of 2026 event. and article, companion article. All right, let's look at the daily chart of the S&P 500. I wrote a note first thing to my market misbehavior premium members after the open saying, look, stronger open looks like we're pushing above the upper boundary. If we can close above there, then get some follow through on Tuesday, it looks like this pattern may be resolving to the upside. If you watched the show last week, we talked about this symmetrical triangle or coil pattern, lower highs, higher lows. The pattern on its own really does not suggest a direction that it's going to resolve, right? Just because that pattern's there, it's literally a neutral pattern. It's often a continuation pattern, right? So all else being equal, resolving higher is more common, but the pattern on its own does not imply a direction of resolution. This is why we want to clearly define the upper boundary and the lower boundary and then wait to see which way it breaks. Today, we're closing above that upper trend line, which I think could be pretty meaningful. If we get follow through tomorrow, meaning a higher move, that would indicate an upside resolution to the symmetrical triangle pattern and imply much further upside than what we've seen so far. Certainly would imply a move beyond previous all-time highs around 7,600. Other thing I would say to qualify it, besides that follow-through day, would be the RSI pushing above 60, right? So the RSI, the momentum has been neutral. And so pushing above that 60 level would put it back in the bullish range, implying a new accumulation phase. So we're at the upper end. We're at that point where it starts to look like a nice breakout to the upside. Saw an initial sign today. Do we get confirmation tomorrow? That's what we'll be looking at in the morning for sure. While the S&P is potentially breaking to a new swing high, we're also seeing breadth data remain quite strong. Breadth was kind of mixed today, but the trend in breadth over the last couple of weeks has been remarkably strong. The advanced decline lines for the New York Stock Exchange, for large caps, mid caps, small caps, all made new all-time highs at the end of June. I'll say that again. All the advanced decline lines made new all-time highs at the end of June. So while the S&P and the Nasdaq are still not testing new all-time highs, maybe rotating back up there, the breadth is quite strong. I had a live stream last month with two money managers from Tamarisk Capital Management, Ryan Gorman and Vince Randazzo. We had a really good discussion. We're actually planning another live stream here in a couple of weeks to kind of continue the discussion. So we had some really good feedback on it. And, they actually use breadth like this as the main input in their momentum model, not the chart of the S&P. They're using the advanced decline data because that's, in their opinion, a better representation of strength. And we're certainly seeing strong breadth. So S&P trying to get back to new highs, advanced decline lines already do it. Other breadth indicators pretty strong here, right? We can see 68% of the S&P 500 members are above their 50-day moving average. We're close to 70%, which is more at the upper end of that normal range. And we've got 2/3 of the S&P above their 200-day moving average as well. Now, before you get too excited and say, all right, this indicator is almost to the big red line, is that bearish? It actually usually is not. And here's how I use the indicator. Right? If you look back, after we've been below and finally break above that 70% level, that means 70% of the S&P members are above their 50-day moving average. That actually usually means we're at the beginning of a pretty good uptrend. For me, the warning sign is not when we go below 70%. It's when we go below 50%. That's when it tells me all of a sudden we're starting to rotate into a much weaker position, which means we're consolidating at best, which means we're deteriorating at worst. So above 70%, not that bad of a sign. Below 50%, that's a pretty bad sign. So the fact that we're getting to an extreme reading for me is not the end of the world. No longer being near extreme readings after getting up there, that's where you want to start to be concerned about. So for now, I would say this breadth is generally constructive. We mentioned the VIX. The VIX, of course, down below 16 today at the close. This is the lowest closing level we've seen since January. This is a volatility regime that is very much in a low volatility phase, which tells you just the market is not pricing in significant price swings. What's helpful about this type of period is essentially all we need to do is look for a spike in the VIX, and those initial couple days of a spike in the VIX can be a very negative, very painful corrective period. Could be short-lived as it was back here in June, but certainly something you don't want to ignore. So let's keep our eyes peeled for that. Chart of the GLD still in a primary downtrend, right? So before we get too excited, and I would say on a tactical time frame, I love the bounce in the GLD. We're close to breaking above the 21-day exponential moving average, which I would think would be a really good first step to be taken because we've had a number of counter trend rallies that have stalled out there. For me, though, I would need to see a break above this trend line. This trend line really clearly represents the downtrend phase we've seen since the end of January. Getting back above that trend line resistance would be a meaningful shift in trend. In terms of momentum, look at the RSI down at the bottom. The momentum's still pretty negative. The RSI is still well below 50, as it has been pretty consistently since February. So price breaking above that trend line, RSI getting above 50, ideally above 60, indicating a new surge in upward momentum. That would tell me that the picture's changing in gold. Until then, I label it guilty until proven innocent. Watching that bullish divergence, though, certainly something that jumps off the page at me. All right, Bitcoin. So a bullish divergence here on Bitcoin. So I would think it's noticeable that on the chart of gold, the chart of Bitcoin, we have these bullish momentum divergences. That's where we're getting lower lows in price, but higher peaks in momentum. That higher low in the RSI is an important shift I think we want to pay attention to. Today, we've got what you probably label a hanging man candle. That's when you have a big run higher. You have the open and close near the highs of the day, limited upper shadow, long lower shadow. That would imply the next 1 to 3 bars are more likely lower than higher. However, I would say, if that would happen, still this divergence feels to me like we're in some sort of bottoming pattern for Bitcoin. 58,000 would be the lower end of where I think that still makes sense for now. I like the bounce above 60,000, waiting to see if we get further of a recovery. I do have a position in GBTC, trying to play this upside rotation in Bitcoin. That candle today, not ideal. I won't lie to you. That suggests the next 1 to 3 bars may be lower. We'll keep an eye on that one for sure. All right, so some individual stocks to finish off our show today, and then we'll grab a question or two before we finish off. Sandisk, right? So the charts of Micron, Sandisk, like the SMH, all very similar charts right now. These are some of the stronger areas in semiconductors right now, Micron and Sandisk. These uptrends have been in play for quite some time. Look at how consistently that Sandisk has been above its 50-day moving average. And the far left side of their chart, you've got July, August into September of 2025. Sandisk is down at $50 a share on an adjusted basis. Currently, we're at $17.44, coming off of an all-time high around $2,400. So obviously, this has been an incredible rally that we've been in over the last 12 months. But at what point does an incredible rally turn into something different? Well, if we break below the 50-day, all of a sudden this feels like a different trend. Previous pullbacks to the 50-day moving average have seen the RSI hold the 40 level. This is where I feel like the range rules in RSI are so valuable. I can't tell you how many times I've been saved from severe capital loss by just paying attention to breakdowns of key moving average, paying attention to when the RSI breaks below 40 and recognizing that means there's enough downside momentum that the uptrend is just starting to shift, and it's changing to the degree that I probably want to be changing my positioning as well. Not a great day for Sandisk. I mean, it was flat for the day, but in a day when a lot of technology stocks were up quite a bit, I think it's noticeable that Sandisk did not participate and essentially was unchanged from Thursday's close at the end of last week. Let's keep an eye on the 50-day, also RSI 40 level to see if that would hold. For now, it is. Berkshire Hathaway having a pretty good June, starting off July pretty well also, but now we are approaching what we call a severe resistance level, what we might call a confluence of resistance. Look at how many times that Berkshire Hathaway has gotten up to around 505, 515, 510, somewhere in that range. Look at all of those highs. All is where we have failed in previous attempts to break out. We're kind of right back up. We've round tripped back up to that previous resistance. That level around 507 is also a Fibonacci level. If you look at the big drawdown that we had in mid 2025, we've been keeping an eye on those levels, and we're kind of right back up to that previous level of resistance. So great chart, I would argue, if it can power through that range, but we are approaching major overhead resistance. So I think there needs to be enough momentum to get through that level. So for me, it's wait and see. If we've missed out on that rally to date, I think I would want to see if it has enough momentum to power through. I just want to highlight, we had a bearish engulfing pattern on Thursday. This is Wednesday and Thursday, and that's actually not true. It's not a bearish engulfing pattern because this day was a down close, not an up close. You probably have to call that a bearish outside day, which is pretty similar. That's just a bar chart vernacular for saying a second day with a wider range and a down close. In either case, suggesting some short-term weakness. I'm just highlighting on the chart all the times when DAL, this is Delta Airlines, has had a pullback to the 21-day EMA and in a lot of cases to the 50-day moving average. These have been some pretty decent, actionable pullbacks within the uptrend phase. But at some point, that pattern starts to break. For now, we're overbought. And again, all of those little pink arrows have come after we've been overbought and come out of that overbought region. So certainly feels to me like Delta is in pullback mode here to start the week. How far does it pull back to, and when do you feel comfortable sort of buying into short-term weakness, if that's something you're inclined to do? That's going to be the question to think about through the course of this week. But I would say short-term weakness seems to be the rule for now with DAL. Aerospace and defense charts, a lot of names in that space have been interesting in recent weeks. I'm noting that the XAR, which is the S&P Spider Aerospace and Defense ETF, testing major resistance. Think of this as a big basing pattern, which is like a rectangular shape on the chart. We have pretty clear resistance here around 290. We're right at that point where a break above current levels would complete a rotation higher. One of my Fidelity predecessors, Bill Doan, would call that a big base breakout. He made a career out of identifying those charts and sharing them with Fidelity portfolio managers. So I think of Bill, when I see a chart like this, really close to what could be a meaningful breakout on aerospace and defense stocks. All right, let's get some questions. I see some suggestions. Larry Williams, I'll see what I can do. He has been passing on most podcasts recently. Unfortunately, he's lightening up his content. I'll see what I can do for sure. So a couple mentioned the weekly chart, and thanks for mentioning that. Zooming out to the weekly chart is always a good approach. And I would tell you, anytime you're looking at a daily chart, and if you have that moment of hesitancy, like, all right, wait, is that the right way to think of this? Always, when in doubt, zoom out. Bring in more data, right? Zoom out a little bit. Think about how the daily chart that you're looking at fits into the larger picture. And I would argue not enough traders and not enough individual investors recognize that larger time frame, right? We get so caught up in the flickering ticks, the short-term time frame. And that was in a lot of ways why I started a daily market recap show years ago, was I wanted to update on what was happening today, but then always connect what we saw today with the bigger picture, right? What does today mean relative to these larger trends? That's why we always identify, look, this was a nice day, but here's a key level. And unless we do this, today really wasn't that, really wasn't moving the needle. So a lot of times zooming out to the weekly chart can help you just bring in context, right? And understand how one day or 1 week fits into a much larger period. And I think that's really important. At 3P Investor, thanks as always for tuning in, my friend. You said, when you use the new 3-month highs list, should we not monitor for short squeezes as a possible reason for its sudden surge? 100%. And honestly, I'm glad you asked that. I don't use short data as much as I should. I mentioned last week, I was in the Stock Charts headquarters meeting with Grayson Rose, and we were talking about some development that the developers there are doing, and some new stuff that's going to be on Stock Charts hopefully very, very soon for all of you to enjoy. And one of the things that we'd actually talked about was the short data, and looking at short interest as a percentage of float, and some of the other fields that I would love to scan on. And so really excited for that to be more readily available in Stock Charts. I think it'll be a great upgrade for the platform. One of my predecessors at Fidelity, Phil Erlanger, made a career out of looking for the Erlanger short squeeze, right? Looking for stocks that were sort of set up with a heavy short position. And if you're not familiar, short squeeze is way too many people are short the stock, the price starts to go up, and eventually, if you're short, your broker starts wondering about that short position that is less and less profitable. And so often you'll be forced to liquidate, or you have to cover your short. Either you do it on your own or you're forced to do it by your broker. that covering of the short is just like a buy order. I mean, basically provides a buy order into the market. So it tends to push prices higher. So a short squeeze is when you have a stock that's heavily shorted, the stock starts to do well, and then all of a sudden it just feels like it accelerates. And that's all the shorts getting caught on the wrong side of things, and they have to get out of that. That was a, part of the whole, meme stock phase was, heavy short squeezes, right? That caught hedge funds on the wrong side of some of those meme names. But it happens at a lot of different places. So for sure, I think with a lot of names, when you see something starting to rotate higher, keeping an eye on short interest, particularly short interest as a percentage of float. That's the number you want to look at, because that basically shows you how much of the available, right, the publicly available shares, what percent of those are short. That's usually a really good set of things to look for. I'll let you know when I get updates on when that type of scan might be available on stock charts. For now, I'd encourage you to look for that data anywhere you can. In the meantime, have an awesome day. Happy Monday. Go USA. We will be cheering them on over Belgium, we hope, later this evening. Hope you guys have an awesome start to your week. We'll be back tomorrow with a market recap. In the meantime, remember, it's always a good time to own good charts. Take care, folks.